So let's just get right into the meat of the module, shall we? This video lesson is going to go over just some definitions, some structured setups, and every single one of the guidelines for the various cornerstone trades that I am going to be sharing and giving you access to. And I'll bring this over right here, so that you can begin to learn how to make this your own. All right. The bottom line to all of this is, if you are watching this video, if you now have access to all of these video lessons, you and I are already into a relationship of some one-on-one training. Okay, so right off the bat, just understand and accept the fact that I'm not going anywhere. I'm here, accessible to you, to help you, and this is just a good starting point, a very good jumping off point to go through each one of these different trading guidelines to share with you why I believe these are the most powerful and most resilient styles of trading, and get you up to speed to where you rely less and less on me and more on yourself. All right, so that's, I believe, the bottom line is the reason you're listening to this is because you want to learn how to do it yourself. You don't want to be told what to do, right? I mean, you want to be guided into understanding how to learn to do it yourself, but ultimately you're probably a pretty self-motivated, self-directed person who wants to learn how to do this on your own. And this is a good starting point, a great way to say, okay, this is experience trading in the markets from somebody who's been trading for over 10 years, and these various different guidelines and these various different setups will get you absolutely to a profitable state of trading in the shortest time as possible. And then it will give us additional material that we can discuss and share and talk about in our one-on-one mentoring. Okay, so right off the bat, let's just get those definitions out there that I'm not making these available to Joe Public. All right, these have been acquired by many thousands hundreds if not thousands of hours of time spent developing and training and trading and experimenting and testing, sim trading, live trading, back testing, all different variations. And I think when you accept the fact that it's quite simple, then the trading becomes very enjoyable. So the definitions of all of these, they're all going to follow the similar format. All right, so I'm going to just open up this first one here. This is the core, one of the main trades that I want you to start out with testing, and sim trading, paper trading, and we'll go through. There will be many examples through all different market conditions in a subsequent video lesson down below for examples on this one module, this one setup, this one guideline, to show you and reveal to you the power that this actually possesses. Okay, and this is what I put on the introduction video lesson. 125 words. That's all it takes. All right, and so by definition, this is one setup. You'll notice here I have 8 of them that we're going to be talking about in this video lesson. We'll go through all the different guidelines, all right? And the overlap, I think, is enough so that if you only traded this one right here, you would be fine. You would never probably need to trade anything else again. However, when you overlap that with, say, a condor type trade, or say a time trade, say you add some weekly options in there. There are many different elements that come into play when you understand each one of these individually, and then you start overlapping them with one another. Then I believe you create what is truly significantly powerful, and so that all along the way you're mitigating risk, you're trying to remove risk, you're protecting your capital. You just I look at it like this, okay? You're trying to create as many barriers between you and your account going to zero or blowing your account up as possible. And at each barrier, at each boundary that you put between you and that catastrophic loss, the better. And one way you do that is by learning multiple different methods, multiple different strategies that some work better in certain market conditions. For example, a low volatility environment is going to react differently than a high volatility environment. So one set of trades will perform exceptionally well, while another set of trades will perform poorly. And yet when those overlap and you have multiple strategies that are trading simultaneously in real time, and they're managed independently inside of one aggregate account, well, that just adds another boundary and another layer between you and a catastrophic outcome. So that's the whole approach. That's my way of looking at these different modules, these different setups, these different guideline PDF trades. And so let's just run through each one of these a little bit more in depth so that you can kind of see how it is we're going to be trading them. And again, these are trades that I trade in the live market, in live accounts with real money, and I have been for several years now. All right. Do they adjust and do I make little tweaks here and there? Of course. That's what options trading and that's what being responsive to the market is all about. Being reactive to how you grow as a trader, but the fundamental concepts are not going to change. And so in this particular T1 core, and I refer to these as just T1, T2, T3, T4, T5, T6, T7, T8. So I look at this as there are 8 pillars holding up my entire trading arsenal, right? And this particular one, this very first one, I think is the most resilient. It's one of the most powerful. You can trade it one time a year. You can trade it one time a month. You can trade it every couple of weeks. I put here, we'll trade it every Friday using either the weekly or the monthly options. And, these are the constructs and the management. You adjust this and tweak this to fit your personality, but this is just the starting setup, the starting guideline using the Russell or the SPX. If I am deploying $5,000 per butterfly and it's something that I'm putting on every Friday, you can obviously see that the account's going to need enough capital so that if I need to absorb 2 or 3 or 4 consecutive losses in a row, well, it's not going to blow up my account, because if I am risking $250 on a $5,000 trade, well, that's 5% of the margin required for this trade. It's not 5% of my entire account. All right, so that's why the money management aspect of this is so important, and yet the money management is entirely different than risk management. We're managing risk differently than we're managing our money. And if we put this trade on every single Friday, that gives you 52 trades a year. And if you have a 1-to-1 risk reward relationship, ratio there, I assure you this trade wins, and you'll see that in the example video. This trade wins much more than 50% of the time if it's managed appropriately. So again, here's the construct and here's the setup. Russell or SPX, capital outlay is $5,000 per butterfly. That will change depending on wing widths, strike selection, days to expiration, etc. But if we put this on every Friday, utilizing either weekly or monthly options that expire in 70 to 85 days, and here's how we construct them. Upper long delta is at 39. The short delta is less than 26. Lower long delta is 13. We're using the puts only. All right. Our take profit is $250 per butterfly. Maximum loss is $250 per butterfly. And here are the adjustments. All right. The very first day right here. So we're going to outline that right here. The very first day the trade, the market closes below the lower long strike, you're out. The trade is over. It doesn't matter. You're not going to be you're not going to be greater than your $250 maximum loss. So that just means that the market has moved significantly enough from inception to closing under the lower long strike, and we don't want to be in it anymore. We have another trade coming up the following Friday, right? So we just close it out. We do not overanalyze and over-adjust this trade. On the upside, we do not touch it until we get 30 days to expiration, or our take profit has been hit, or theta becomes negative. That's it. That's the upside adjustment. If you're under 30 days to expiration and the price is more than 2 standard deviations above the short strike, then we roll the upper long 10 points down. That's it. Very simple. It's very rule based. You have, this can all be done after the market is closed, and so there's not a lot of need. There's no need really to be watching the market intraday, because you'll be able to look at the end of the day if the condition has been met requiring you to make an adjustment. All right. And again, I'll have one entire video where we're going to spend a significant amount of time going through real life, real world examples on how this reacts in the different market conditions: low vol, high vol, super bullish, super bearish, range bound. So if it's not fully gelling just yet, don't worry about that. One of the videos down below is going to have that in much greater detail. Okay. And then lastly, there's no subsequent adjustments after that first one. It's kind of like a one and done type thing. Low vol requires increased patience. Consider entering on a down day. Is that mandatory? No, of course not. You can enter it on an up day, but I put that in there because you will have better fills on a down day when the volatility is increased. All right. So super, super simple. If you'll just follow that one set of structured setup, I think you may find that, I don't know, some people may say that's all I need, but when you layer that on top of all these other ones, you truly create the environment to where, you're trading in a titanium structure that it's super resilient. It is going to be very difficult for you to find yourself, blowing up your account, as long as you're following kind of the path that we're talking about. Now, condors. Again, here's the setup, here's the guidelines. You'll have access to these PDFs. You can print them off. You can tweak them, adjust them to fit your own need. But again, this is, as I said here, T1 is the simplest construct. T2 is very simple as well, but it gives you a different flavor for put only condors. All right, it's not an iron condor. It's not credit spreads. It's a credit spread and a debit spread together, and that's what makes it a put condor. All right, you can use it in the SPY. You can use it in SPX, in Russell, in NDX, in equities, you'll need to experiment with the different vehicles, but for learning, we're going to just stay in the SPY, and we'll deploy anywhere between $2,500 to $5,000 per tranche, all right, so per unit, and that will give you the following setups, all right. 20 to 40 days to expiration. We're gonna go out farther in time when the volatility is low. We may come shorter when the volatility is higher, but we're probably not going to ever come any closer than 20 days to expiration, because that is just way too close. The time premium has started evaporating, and we have a weekly hot sauce trade that utilizes options expiring in 7, 8, 9 days. So there's no need for us to go any closer than 20 days. But again, this is kind of the range where you want to start putting these trades on. We'll not open them in an expiration week, prefer to wait for a down day. And here are the strike selections. Put credit spread 8 to 10 delta, 6 points wide, 5 contracts total. Step 2, put debit spread 1 point below the money, 5 points wide. It does not use the call credit spread, so it is not an iron condor. It's a put only condor. Here's some target profits. Here's our maximum loss. And again, it gives you this kind of a profile. After you have made adjustments, you'll notice there are no initial upside adjustments, meaning if the market goes up to infinity, it's that we let the market go and do its thing. We don't make any upside adjustments. Downside adjustments are as follows. When the market closes the short strike of the put debit spread, remember there's only 1 point below the money, 5 points wide. All right, and I'll show that again in one of the video examples down below, how we'll set this up and how we'll trade it. But the first time the market closes below that, then we have choices. We either close the original put credit spread and reopen it farther away, we double the size, we get ourselves in a position so that we are creating more distance between us and the market. And when you do that and you respect your risk, then what that does is that gives you the best likelihood, the best odds, or the best probabilities that you will be able to continue trading for a very long time. All right. Now, most important items: low vol environments make the trade management more challenging. Patience on entry. We don't go chasing price, and consider waiting for a down day. If you're when you're in profit taking mode, if you're close to expiration, consider closing the put debit spread to manage deltas. Caution going into expiration, especially if the debit spread goes in the money. Immediate exit if max loss is reached. That's the number one bullet point right there. If your max loss is 10% of your deployed margin, so if you put on a $2,500 trade, then your maximum loss is going to be $250. The instant that that is hit, you close the trade. No ifs, ands, or buts about it, because here's my experience. You start adjusting, you start managing, you start over analyzing, you start trying to tweak your guidelines on the fly, so to speak. Well, your max loss is going to significantly increase from 250 to much greater than that. So we just want to not play that game. You're not going to hit max loss very often, but you have to be prepared to honor that maximum loss if and when it does get hit. And that's mandatory to accept when you're trading. If you say you're going to do something in advance and you don't do it, you are reinforcing bad behaviors. And let me just tell you, it is much better to lose money knowing you followed your trade plan and you honored what you said you were going to do than to make money breaking rules all the time. And the reason why I say that is because if you're breaking rules left and right, you're not honoring your trade plan, you're not doing what you said you were going to do, you have no ownership of self during your trading, then what's going to happen is it's inevitable you are not going to make it long term. You will not be consistently profitable over the long haul. You will blow your accounts. And so I'd like to really have you, chew on that, because nobody wants to lose money, but you better accept the fact that if you're actively trading, you are going to lose money. Your trades, 100% of your trades are not always going to win. And so when it's time to close up a trade because it's hit maximum loss, close up the trade. All right. That way you have that ownership, you have that self-accountability, you have that discipline to know you're going to do what you said you were going to do. And guess what? Then you'll watch and you'll see and discover that the edge plays out, the probabilities are in your favor, the math and the statistics are on your side, and you will be consistently profitable over the long haul. Okay, so didn't mean to go on about that, but it's important. And you have to close these trades if they hit maximum loss. And if your maximum loss is XYZ amount and you hit it, you have to close it. All right. Immediate exit the Friday before expiration week, unless you have created a risk-free trade. I like to be out of these prior to expiration. Sometimes there are trades I will hold all the way up into expiration and let them expire worthless, but you have to understand when that's appropriate and not appropriate to do so. And then lastly, immediate exit if price action penetrates and trades under the long strike of the put credit spread. And there will be conditions and scenarios when that happens where you have not hit your max loss yet and the market has moved a significant enough amount. Remember, the construct is at the beginning, our put credit spread opens with a delta of 8 to 10, right? So if a delta is, if our delta is at 10, we have already moved a significant amount because we have 6 points wing width from the short strike to the lower long strike. And if the market has penetrated and traded under that long strike, that means it has moved a significant amount in time or in distance in a short amount of time, because we're opening these 20 to 40 days to expiration. So don't even play around with it. If you haven't hit your maximum loss and it's moved that much distance, close the trade. It's done. It's over. You're opening up the next cycle, maybe in a few days, maybe in a couple weeks. You're always going to have another trade coming around the corner. If you get married to some of these, you're going to be trading emotionally, and it's not going to produce long-term consistency. All right, so that's the second one. That's only T2. So right there, those two alone probably will encompass the majority of trading that you will find. You'll have more than ample ammunition to be successful. All right, but let's keep rolling. T3. Core butterfly trade. This is modeled, and this is similar yet a little bit different than what John has as the M3 core trade, and that was when I personally made my transition into consistent, profitable trading. When I learned how to trade the M3, that for me personally, that was my light bulb aha moment. That was when things began to click. That was when my equity curve began to change. That was when the profits, I started understanding a lot of the missing pieces started falling into place. And so this is one of those trades that it's a little bit more advanced. It does have a few more moving pieces to it, but it is it is as resilient as they come if you manage it properly and you understand how it's constructed. So let's just run through the guidelines and the setup on this one. All right. Again, it's a core trade. It's a butterfly trade. So there are varying wing widths. It can be set up as an iron butterfly. I like the put only butterfly setup, but it can be traded as an iron if you choose. But let's just start out saying that we're going to keep it in the puts only. It's a put butterfly with an in the money call. Now, you can use the Russell and IWM combo for smaller capital outlay. You can use the Russell-Russell combo for larger accounts, but I put here this 60-day expiration entry point. There is nothing magical about when you put this trade on. And the reason why I selected 60 days to expiration is I was showing a group of traders in a community that I was trying to get some options traction going in the James 16 community. And those of you who know me from there understand the history of that. But I use that as just a way to share with traders. It doesn't matter really when you open these trades. And what I was trying to show is a 6-month case study of only opening on Mondays when there is 60 days to expiration and managing the trade following these guidelines, according to these guidelines. And the reason why I did that is I wanted to prove the point that you don't need to try and time the markets. Yes, there will be more ideal scenarios or timelines when you can open these trades, but you can open these trades regardless of what the market is doing. And if it's managed appropriately and according to some guidelines, you have a good chance of having a profitable outcome. So again, there's nothing magical about the 60-day to expiration. I use that as a starting point. It can be opened on 56 days, on 76 days. We want to be out in time. We don't want to be trading this with 20 or 30 days to expiration. You can trade it as a 60-day to expiration trade, a 90-day to expiration trade. You can vary with the time to expiration, but 60 days is about the sweet spot. So that's where we'll start out on that. Step 1, you'll buy a butterfly first, 50 wide, short strikes, or 15 to 30 points under the market. Again, we'll have a whole entire video lesson showing example after example after example of different market conditions, how it's going to perform following these guidelines. But notice that step 1 is not buy the in the money call. There's a reason that step 1 is buying the butterfly first. That has the widest spread. Sometimes that's a little extra challenging to get the fill on. And if there is less than optimum open interest or volume traded, you want to get that butterfly launched first. All right. So after the butterfly executes, then you go, and step 2 is buying an in the money call with a delta greater than 80. Will a delta of 50 work? Of course. Will a delta of 100 work? Of course. But that will change. That will cause the trade to react differently. So 80 is where I want you to start at, trading with that in the money call at a delta of 80. Take your screenshots of risk profile at inception, along with at the end of each market day, if you do it once a week, you need to take your screenshots so that you can document and chronicle the trade from birth to death, and then go back and recap if you followed your rules, did it perform the way it was expected to, etc. So volatility is monitored, but delta and theta are primary emphasis, and that will become very clear when I go through and show you how this trade performs. Here's some target profits. Maximum loss, similar to the put only condor. It's a percentage of the margin deployed. So if the margin is it's a $22,000 trade, well then of course, you know, you're gonna end up having that trade come out to, you know, if you have a $22,000 trade and 15% of that is, you know, 3,300, well, you better honor that maximum loss. And while you're waiting for your target profits to be hit, then be prepared that that's an amount that you have to be willing to take the loss on. And I talked a lot about that already a few minutes ago. So initial adjustments. Downside initial adjustment. If when the price trades 20 points under the short strike. So we let it violate the short strike. If it does, then we consider rolling the butterfly down 20 points. Notice it doesn't say mandatory roll the butterfly down 20 points. No, it says consider. So that right there should show you that there is some, you know, subjectivity into trade management and how you acquire that confidence or that ability to learn when you should or when you shouldn't is by doing it. And that's by testing, that's by going in your back tester mode, that's by going in paper money and seeing what happens when you do, what happens when you don't, and then making that determination yourself based upon what your confidence level is at. Now, when you're starting out, just roll it down. Roll the butterfly back. There's plenty of time to salvage the trade if it reverses on you, but if it keeps dropping and you have not rolled the butterfly back, the spread gets wider, the fills get harder. So when you're first starting out, I would just say, yes, odds are better to just roll the butterfly back. As you get more skilled, then you can decide, well, let me let it go to 25 or 30, or maybe I'll just, if we're at an inflection point in the market, maybe I won't adjust, maybe I won't roll the butterfly at all, maybe I'll just add to the trade. Again, these are all variations that I'll show you that you will be the one making the decisions yourself on how to manage on that initial downside adjustment. We do not adjust the in the money call at this point. All right, so that's the first adjustment to the downside. First adjustment to the upside, if when price closes 10 points higher than the upper long, consider rolling the butterfly up 20 points. All right, in low volatility, consider moving up only the shorts and leave the upper longs alone. Again, we'll go through all that in great depth in the video down below. Subsequent adjustments, if when price trades 20 points under the new short strike, roll the butterfly back another 20 points versus just closing the trade altogether, especially if the speed is fast. If you have a collapsing market that's crashing quickly and hard, and you've already rolled it down once, you're prepared to roll it down again, sometimes it's better to just close the trade up entirely and wait for the next cycle, especially if it's moved that great of a distance and you have not hit your maximum loss as of yet. Just close it up and then wait for the next cycle. Subsequent upside adjustments. So we've already made one, let's assume. Now we're getting ready to make another one. If the price trades at the upper long strike after you've rolled the butterfly up, consider doing it again. Or if you're under 30 days to expiration, consider moving the shorts up or the upper longs down. That is when you are protecting your profits. All right, that'll become very crystal clear when we start going through the video examples. It's a very, very forgiving trade, and it helps reinforce and teach you what I'm always talking about week in and week out on the weekly update. Friday Fives is why that T+0 line is so important to keep handle on. Keep that thing flat, right? Extreme caution as you get under 30 days expiration. Low vol, keep a slightly negative delta. No more than 2 rolls down, especially in a fast market. Again, honor maximum loss, move on to the next cycle. If one trades up over 8%, begin considering exit maneuvers. If when you're up over 15%, protect profits and never let it drop below 8%. I call that, and I refer to that as tightening the noose. All right, That's you know, I'll use the analogy, the example, if you're trying to catch a wild horse and you throw a lasso around the horse and it's, you know, it's loose and you're just kind of following it along and you're trailing it. At some point, if it tries to get away from you, that noose tightens, and that's exactly what you're doing here. If you've got 15%, if you've got a 15% return on capital trade on the line, on the hook, you do not ever want to let it drop below 8%. If you do, shame on you. If you're trying to get greedy and you're trying to maximize and get a 20 or 30 or 50% winning trade, you know, that's just something you have to be very, very cautious of. If I've got 15% on the hook, I am never going to let it get below 8%. Now, if that continues to cooperate, and now let's say that's moved from 15% to 20% or 25% or 30%, well, I'm not going to let it drop all the way back down to 8. I'm going to be trailing this up as well to maybe 10, 15, 20, etc. All right? And if you want to be ultra conservative, keep your resting orders in to close it when you're up 5%. Again, immediate exit if max losses reach. Sometimes you get that volatility drop, and that's related to skew and how the out of the money options perform differently than in the money, and you know, share that as well. If you don't know what to do, or you start stepping on strikes, or you've had a couple of adjustments and now you're getting a little bit confused, if you don't know what to do, call me for an emergency meeting. We can look at your position, but the first and foremost, you need to always be protecting your capital. If you don't know what to do, exit your trade and then piece it together so that it doesn't happen again. And that will happen. It's inevitable. It's either already happened to you or it's going to happen to you. You're going to make an adjustment, and instead of closing one, you're going to accidentally open a new leg. You're gonna step on strikes. It's going to happen, and when it does, you don't need to panic. You don't need to freeze. But if you don't know what to do, you have to protect your capital first. That is first and foremost. Okay, so the T4 and T5 are similar to what I've got on the site as far as the time traveler, the free trading module. These are just diagonal. They're time spreads to where your short strikes are in different expiration cycles as the long strikes. And again, these guidelines, these are not my preferred trades, but there are times and there are conditions when they work very well. All right, and right now it's mid 2017 as I'm recording this, so we are in ultra low volatility environments. So that's a more ideal time to trade these diagonals and these calendars. All right, these time spreads, because you benefit from that rising volatility between the front month and the back month. All right, and again, we'll go through this a little bit. I won't go through these two as much in the example videos. What I'll probably do is I'll probably put both of those in one video as opposed to keeping them on their own, because I've already got several videos in the time traveler module that will show you how the time spreads work. Now, the weekly hot sauce trade. This is a trade that is intended by design to be a very, very small amount of money. It's a speculative trade. You know, think if you have the proverbial $100,000 trading account, you're going to maybe deploy 1 or 2%, you know, so maybe a couple of $1,000s in margin, not in risk, but in margin, to trade these trades on a weekly basis. And again, these are quick hitters. These are designed to be dinner and a movie type trades, to where, you know, you're not looking for big winners, but it's to keep you active and to keep you in the markets while you're letting some of your core monthly, longer term trades, some of your larger trades decay their theta and decay their time premium. So this is one way to still stay active and let the market, let our knowledge of how options decay in the time premium when we're selling theta, when we're selling time, the edge is in your favor when you do that. All right, because the way options are priced between implied volatility and statistical volatility, by default that edge is in your favor. And so when you sell that time premium, at the outset, the edge is already in your favor. Now, it's up to you to manage your risk and to manage your money accordingly. But if we put this trade on 52 times a year, because we're putting it on once a week, and it wins 40 and it loses 12 times, well, as long as we are honoring our target profit and our maximum loss parameters, you will be net positive. You will have a positive expectancy model by the end of the year. And again, it's another way to put another barrier and another layer between you and blowing your account. And I don't want anybody to focus all their attention on one module only and one trade only, because you need these other layers, in my opinion, to offset the risk from being super specialized in one type of trade only. All right, you need the confidence in understanding several trades or one or two. You need to have the proficiency and the mastery in each one of these trades, but not at the cost of not learning the other ones. So I hope that makes sense. I hope I'm explaining that. The danger is to put all of your eggs in one trade and miss out on other trading opportunities. All right, and maybe maybe by the time you get through watching all these hours and hours of video lessons to follow, maybe that'll make more sense. But just understand that it's about multiple layers and trading multiple strategies, but managing them all similarly so that you keep the math and you keep the edge in your favor. So this is just it's a simple iron butterfly. You'll have your short strike right at the money, or they're separated by one strike only. Your upper wing is 4 points, your lower wing is 7 points. You can adjust these upper and lower wings, the long strikes, depending upon the credit that you receive. But notice you will receive a credit into your trading account, and so that will require you to post margin to keep that trade open, but the net result is a credit into your account. So your job is to keep as much of that credit as possible, but at some point you're going to have to buy it out, which will result in a debit from your trading account. All right, and so the target profit, 5% of margin, 10% only after you have 3 consecutive winning trades. All right, and that's going to be much clearer when I show you the trading examples below. But if we have 3 consecutive winning trades and we have now accumulated 5%, 5%, 5%, well, then we relax just a little bit and we target a little bit higher amount while not giving up more than 10% of the margin required to keep the trade open. That's our maximum loss. There's no adjusting on this whatsoever. There's no adjusting on this whatsoever. There is no adjusting on this whatsoever. It's a open and closed type trade. Part of the reason for that is because it's very easy and simple to set up contingent orders and let those rest on the platform. And again, we'll go through, I'll show you exactly how to set that up and exactly how to do that. Only consider on the ultra liquid instruments. SPY is a great candidate. That's what I do it in. You can experiment with the SPX or the Russell, but SPY works just fine for me, so that's what I do it in. Monitor closely in the final days before expiration, and your expiry break even is touched on either side. That's when you immediately exit, regardless if you've hit profit or if you've hit maximum loss. You'll close it up as soon as it starts trading outside of that tent structure. Okay, and again, we will show that more in detail in the video, in the example videos below. Now, this is another variation. It's a variation of the broken wing, unbalanced butterfly. And again, you know, we start out here. This is going to be similar to the core trade up here, but it is going to perform a little bit differently. All right. Now we'll go through. You'll notice that there are some adjustment considerations to look at, but it's a little bit different than the other one. All right. So we'll unpack that in the video lesson below. And then last, hedges. We need to talk just for a minute or two about hedges, because there's a lot of conversation, a lot of discussion in various communities about, do you hedge, do you not hedge, how much should you hedge? Here are my thoughts on hedging. When you're trading smaller accounts, it's definitely less than $25,000, maybe even less than $50,000. I'm not a big fan of the hedging, because you know the probabilities of this style of trading is already in your favor, so you don't want to be paying up a lot of insurance premium. You don't want to be losing those profits because you're putting on all these protective hedges. Now, that being said, if you're uncomfortable taking on the risk that some of these trades require, well, then maybe you're trading too large and you have to just decrease the size that you're trading so that you can develop and acquire the confidence to trade these modules and to trade these setups and to trade these structures. If a $10,000 margin trade is making you uncomfortable, that you feel like you need to start spending all kinds of money to hedge it and protect it and guarantee against the downside risk, well, then maybe that's too large of a trade at the beginning. Start out with a $2,000 or $3,000 trade so you can learn how the trade operates and how the options decay. Then as you get that confidence and as you learn how the trade operates, well, then you can start increasing size. But I just am from the mindset and the camp that believes until you're trading several $100,000 accounts, I think the hedges, in my opinion, are just their waste of money. And you know, you need the hedges when you're trading larger accounts, and we'll talk about that in much greater detail later. But for the smaller accounts, I don't want to be spending the money. I want to be accelerating the profits as much as possible to get that account to a larger size. Now, once the account is a larger size, and I put that down here, I think hedges are absolutely mandatory, because you don't ever want to risk. If you're putting on a $300,000 or $400,000 trade, that is foolish. That is reckless on your part to not protect against the downside. With maybe your cost of putting on that hedge, if you're gonna give up 0.5% or even 1% of your account to hedge against a catastrophic black swan event, well, that's a very wise and prudent decision to make, in my opinion. But notice, you're going to absolutely trade a $4,000 account much differently than a $400,000 account. And my belief is that the smaller accounts, you don't really need to worry so much about the hedges. Larger accounts, you do. So if you have the larger accounts, well, there are many different ways to use those hedges. And again, this is just one way of thinking about it and viewing it. You can either use out of the money ratio spreads, you can purchase at the money debit spreads, or purchase these out of the money puts that are not, these are not set up, these are not designed right here. They're hedges, they're protections, all right? They're not used to be trying to make profit on. They're being used to hedge positions so that you don't have a catastrophic loss. And your maximum loss is always going to be 100% of the debit paid for the protection. There are no adjustments whatsoever. And so if you have a core, let's just say, for example, you have a T3 core butterfly trade on that is setting you back $200,000 worth of margin, and you need to put on, let's just say $2,000 worth of hedge protection. All right, well, that's just the cost of hedging and protecting so that you can sleep comfortably at night, not worrying about risking $200,000 of a trade while you're letting the time decay. All right, and again, I'll go through a few examples to show you some of the ways to set up some of these different hedges to where how a ratio spread performs differently than just the debit spread or the out of the money puts. They all react differently, but the bottom line is if they're not protecting you against that 10 or 15 or 20 or 30% move down, black swan type event, then if they're not effective in doing that, then you should not even be doing them. So first and foremost, if you're putting on hedges, you need to make sure that they're going to be effective. And I'll show you how that occurs and how to set those up so that they are effective. All right. Now, let's wrap this up here because this is way longer than what I intended this definition and setup guideline video to be. But that be that as it may, I'm not trying to rush through all this. My goal is always to provide more value and more content than what is expected. So I want to give you more than what you're expecting. And if that means that I talk for 53 minutes instead of 23 minutes, well, so be it. I'm trying to not ramble. I'm trying to be very clear and articulate. So I hope that's coming through like that. Now, lastly, though, let's just talk about a little bit about account sizes, because I think that this is one way to view it, just to add that barrier, add that layer of protection between you and having, say, a $20,000 account. Let's say you're starting out with a $20,000 account, and how is the ideal or how's the best way to deploy capital? Well, you're not going to put $20,000 into one trade, and then if that trade hits maximum loss 2 or 3 cycles in a row, which it can and might do, well, then all of a sudden you don't see the power, you don't discover or learn the power of options trading, and so options is stupid, and why did I even try and figure this out? No. You need to diversify across these strategies, across these methods, and put that added layer of protection on your side so that while you're gaining confidence, while you're learning, while you're getting that knowledge, growing your account, you're also growing your confidence. And this is one way to do it. If you have an account that's less than $25,000, and again, there's nothing magical about $25,000. It's just it's an amount that for those traders that I interact with that view this as a hobby, they're probably not going to put more than about 10 or 15,000 into it while they're learning it. It's a hobby. It's they're curious. They want to learn. And this is a really great way to say, look, you know what? I'm going to only deploy 60% of my capital. I'm always going to be at least 40% in cash. Therefore, if the market went to zero, and this might reinforce why I say the smaller accounts don't really need hedges, right? If the market goes to zero, I'm never going to blow up my account entirely. And furthermore, I'm further diversified to where I'm only putting 25% into different types of trades, whether that's a road trip trade, whether that's an unbalanced butterfly, a put-only condor, all of these different methods right here, right? I'm only putting 25% into a certain category. I'm only putting 25% into another category, and I'm only putting 10% into a third category. So you think of it as like a triangle or a triad of trades, if you will, where you're only putting a percentage into, maybe I'm putting 25% into the T3 and 25% into this T1 core, or putting 25% into the time spread and 25% into the condor. That's an approach that lets you build core monthly income trades on 50% of your account while staying active on 10% of your account with, making some earnings plays or trading the weekly hot sauce trade, or maybe putting on a directional trade if that's a bull put spread or a bearish butterfly or something along that line. It lets you actively trade some monthly trades, some weekly trades, and still remain enough in cash so that you're not overly stressing about blowing up your account. This can be 70-30, this can be 50-50, this can be whatever is comfortable for you. This is what I trade on accounts I manage that are under 25,000. This is how I do it. All right. If you're over 25,000, well, then we're going to change that just a little bit, and we're going to say, okay, well, now what we're going to do is we're going to say, I'm going to be much more comfortable putting 70% of the account at risk, deploying margin, say on a $50,000 account. I'll put 70% of it in various trade structures and keep 30% in cash. So that might be 25% on a T3 or an M3 or a T2, 25% in a condor or a time spread. One of the core monthly income trades that you have developed confidence and competence in, and then you put 20% split amongst bullish only type trades and these, I like to refer to them as hot sauce trades because it's enough spice, it's enough excitement, it's enough activity on a regular basis, weekly type trades to offset a lot of the boredom from some of these bigger trades. Because when you're always bored looking at some of these longer term, longer time frame trades, you have the likelihood, the danger, the risk is there to micromanage and over adjust some of these trades down here, some of these longer term trades, like say maybe this one. You start it when there's 60 days to expiration. You may go 30 days of not doing anything to it, and in those 30 days you're restless, you're fidgety, you're a trader, so you need to be trading something, right? And when you add these hot sauce, these weekly type trades, it helps temper and it helps reduce that tendency to do that for me, all right? And so that's why I share that with you, because that's one way to offset that. And then you just let the construction of these type of longer term monthly trades work while still giving you enough activity, and the math is still in your favor. The math is still on your side. If you follow your money management principles, you let the time decay, you take your profits when they're there, you honor your maximum loss when it gets hit, and at the end of the quarter, at the end of the year, then you reconcile and you see, okay, do I need to put more in this, less in that? Do I need to change this percentage? Again, it's going to be different from everybody. This is how I trade the accounts that I manage that are larger than 25,000. This is how I do it. All right. So that being said, we are up on an hour right now. I started out intending this one to be about 30 minutes long. I knew it was going to be long because there were 8 modules. There were 10 PDFs to get through. I wanted to get through every single one of them. I knew I was going to share some thoughts and run down a little rabbit hole here or there. But I thought, well, 30 minutes is probably plenty. But obviously I underestimated. So I do apologize. But, you know, let's just suffice it to say that I'm not trying to rush through this for you. I want to give you my experience level and my knowledge about trading and why I think that these modules and these setups are the most powerful ones out there. And when you couple that with staying involved in a community, whether that's at Capital Discussions, whether that's at Locking Your Success, whether that's, you know, if you're in an active, thriving community, then you will continue to grow as a trader. But just make sure that you are keeping the ownership on yourself to learn what it is that you're trying to learn. Okay, don't project blame on others. If you're having trouble getting something and you keep hitting maximum loss because you're not honoring your trade plans, well, don't blame the trade plan. You know, look at what it is maybe that you can do better. And that's my hope, is that by sharing this module and these videos with you in tandem with the one-on-one mentoring sessions and the lessons that we're doing together, you know, on a regular basis, it really helps shorten that learning curve for you so that you can get to that ownership quicker rather than later. Okay, so that being said, let me just go ahead and wrap this up, and the next video is going to go a little bit more in detail on my thoughts on scaling into some of these trades, some of the adjustment considerations, and ultimately how we get to creating that risk-free trade. And that really is going to easily be illustrated by showing you this right here, and why this very first trade, it almost starts out as a risk-free trade from the get-go, from the beginning. And so we'll start unpacking that in the next video lesson. All right, so thanks for listening, and I'm glad you're here.